Hello, and everyone, and welcome. Thank you for joining us for the RSM Business Essentials webinar. This webinar today will focus on cash flow management, where we delve into essential strategies and techniques that can help business owners optimise their cash flow. It'll be a hands-on session presented by Aleesha Bailey. I'm your host, Andrew Sykes, and today we're going to talk about cash flow. Aleesha, I'll just get you to move your screen down there and we'll kick off with our slides. I'm presenting today on the lands of the Ngunnawal and the Ngambri people, and on behalf of RSM, we would like to acknowledge the traditional owners of the land and waterways on which we gather today and pay our respects to elders past, present and emerging. So as I said, today I'm joined by Aleesha Bailey. Aleesha is Head of Strategic Outsourcing for RSM. Welcome, Aleesha.
Thanks for the introduction, Andrew.
Hope you're looking forward to presenting us with some good tips, techniques and examples of cash flow. Aleesha, before we kick off, what's strategic outsourcing?
Our strategic outsourcing services support businesses with managing their day-to-day finance function. Our purpose is providing SMEs, business owners, with the confidence their accounts are accurately maintained and compliance obligations are met. How we provide our services is through best practice accounting and technology to create discussions around business insights in real time with key stakeholders. Our clients are generally SMEs who are not in a position to hire a full-time CFO or financial controller.
Thanks, Aleesha. So Aleesha's got the background and experience. She's seen and spoken to plenty of businesses managing their cash flow. I'm also a director of RSM and I work with small businesses. So between the two of us, we'll hopefully give you some good insights into managing and helping with cash flow. Where there is opportunity to ask questions at the end of this webinar. So if any questions pop up as you go along, just enter them into the chat box and we will get to those questions at the end. So Aleesha, over to you. Looking forward to the webinar.
Thank you. As everyone on this call will know, managing cash flow is one of the most critical aspects of running a successful business. And Catch-22, it isn't the easiest concept for many SMEs or business owners to get their head around. Surely you didn't get into business to be an accountant, right? I work with Rachel, a CEO of a non-for-profit who is a doctor. She studied hard and went into business to provide guidance, help in the healthcare sector, not to manage cash flow. Some of the topics and tips I'll run through today allowed her to simply digest the financial aspects of the business and more critically provide her with guidance and organisation and has enough cash flow to continue providing services to members. I understand that we have a broad audience here today, so I plan to start with some basics and follow into more practical tools which will support you manage your cash flow. On the agenda today, we'll run through the importance to cash flow management. What is cash flow, both inflows and outflows? Many common mistakes SMEs make. How periodic reporting and budgeting can support manage your cash flow. And forecasting. Wouldn't you like a crystal ball to predict where you'll be positioned at the end of this financial year? And then we'll summarise with some key takeaways and some questions. Before we delve into the how, I'd like to briefly discuss the why. 4 important reasons I'd like to preface why it is critical to ensure your organisation has great cash flow management is operational stability. Cash flow ensures that a business can cover its daily expenses, such as paying employees or purchasing inventory, stock and general outgoings. Consistent cash flow management can help prevent disruption to operations. Say if you're a pub who didn't have cash to pay for food that day, or even worse, beer, how would you service your customers? Financial health of the business, a positive cash flow allows the businesses to meet its obligations and remain liquid. Positive cash flow management can mitigate many such things such as unnecessary penalties for late payment, Concerns for meeting employee wages. I believe this can be one of the most important aspects that many of you small businesses owners keep up at night. How am I going to pay employees? Late payments of ATO or state revenue tax obligations, which can result in significant penalties and interest. Why incur additional costs to your business if a little planning could have prevented this? The need to take on additional debt or to cover shortfalls. Growth and investment. Well-managed cash flow can support your business. Consider if or when to invest in growth opportunities. Should you be forecasting excess cash in the business? Could you consider maybe opening a new location, options to consider launching a new product or service, or upgrading much needed equipment and assets to better service your clients? If you're wanting to attract investors or to support growth plans via financing options, investors and lenders are more likely to support a business with a strong cash flow, as it indicates financial stability and the potential to growth and service those loans in the future. Crisis management. Adequate cash flow provides a cushion to handle unexpected expenses of economic downturn without jeopardizing the business. Anyone remember that COVID incident recently, which turned the world upside down? I doubt many businesses were planned or ready for that. Cash flow is the lifeblood of a business. It ensures you can continue to keep running. What we're going to go through next is in planning for cash flow, we first need to understand what it is made up of. To understand this, we need to know what are our cash inflows and our cash outflows. So cash inflows is the money coming into your business. It can come from various sources such as sales revenue. So that's that money coming into you from selling your products and services. Investments, funds from investors, shareholders, or even directors. Other income can be in relation to interest earnings, rental income, or grants and subsidies. Cash outflow is the money going out of your business. Operating expenses being costs for running the business, again, such as rent, utilities, payroll tax obligations. And your cost of goods sold is money spent on producing and purchasing the products you sell. Many other obligations tend not to be at the forefront of many business owners' minds. This can include things such as tax, direct drawings, or loan repayments. Managing the balance between cash inflows and outflows is critical. Essentially, if your outflows are consistently exceeding your inflows, your business might face cash shortages, making it difficult to cover expenses and potentially leading to financial trouble. If you're unsure what it is made up of, your cash flow, the majority of SME accounting systems will provide you with a cash flow statement, be it detailed or a summary version. Here, what we're showing you is a cash flow statement. This reporting tool is Spotlight that we commonly use with Xero, extracting the data to show you where your money is going. So as you can see from here, the operating profit and loss is just the beginning balance to talk about. And then there's a lot of those inflows and outflows that we spoke to before, which isn't at front of mind. So there's readily available tools that automate this to give you those insights. Reviewing this statement is a good starting position to really understanding your historic inflows and outflows to enable you to plan and mitigate ahead. So which leads me into my next topic is common mistakes. The most primary common mistake a lot of small business owners make is not understanding the difference between profit and cash. Profitability does not equal your total cash. Let's be clear. What is profit? Profit is the difference between total revenue and total expenses over a period of time. And what is cash flow? Cash flow refers to the actual inflows and outflows, which we discussed earlier, of the cash in the business. It determines the ability to pay bills and meet your financial obligations. Let's take a look at a little example that I pulled together. Where you see here, we've got the October profit and loss. And you can see here, it's been a great month. We've made $25,000. However, conversely, on the other side, we need to actually look at the cash flow impacts within that month also. So as you can see here, the opening balance in October It's relatively healthy, sitting at $30,000. We have debtors inflowing of $25,000, increasing our cash flow. However, there's a lot of outflows that are going that may not be foreseen, considering timing or even aware that they're occurring within the month. We've got creditors outflowing of $30,000 and so on with your tax and drawing obligations. Therefore, ending in a closing balance at the 31st of October at 2024 of negative $15,000. So there's quite a disparity in terms of the view of a profit and loss being your position to what your actual position is sitting on your cash flow statement. So just a couple of tips on profit versus cash. Be aware of what makes up your inflows and outflows and the timing. As mentioned before, you can get a misalignment of timing for when your inflows are coming in to when you're actually having to pay for the services or the goods that you need to provide your customers. Invoice for your services as soon as possible. Get money into the bank and continue funding the business operations. Monitoring your debtors and creditors are critical and really can support the cash flow management. Regularly monitoring of things such as, do you have significantly overdue debtors? Do you have regular offenders? And at what cost is this happening to your business when they aren't paying on time? Could you consider introducing penalties for late payments, say over 60 days incurs a 2% penalty? I would bet you a lot of customers will try to pay before that penalty is imposed. I often see a lot of businesses also trying to get their credited obligations off the books as soon as possible. Before paying creditors, particularly in times where your business is cash constraints, consider renegotiating credit terms. Can you agree to extending from a 30-day term to a 60-day term to allow for cash to remain in the business to keep servicing other obligations? Which suppliers do you have the ability to stretch making payments? Ultimately, a last resort should be debtor invoice financing. As this will be at a cost to your business, this will eat into the profit margins made on that original service. This is only really recommended to support in the short term. However, ensure you've assessed the actual costs going into an arrangement like this. Our next mistake is overestimating revenue and underestimating expenses. This can quickly lead to negative cash flow impacts. Overestimating future sales can lead to cash flow issues. This is where scenario-based budgeting and forecasting can be useful, and this is something we'll talk to a little bit more later. Additionally, ignoring seasonal variations, not accounting for seasonal fluctuations in revenue, can result in cash shortages. For example, consider during off-peak periods, such as the holiday season fast approaching, offices closing, you're not getting revenue cash flows into the door, but you've still got those expenses such as rent remaining outflowing the door. Managing cash flow at these times is critical. Underestimating expenses. Often many expenses go unreviewed, not controlled, or have any budget to maintain accountability. A good personal example for me is when I go to Chemist Warehouse. Every time I go in thinking that I'm going to buy that one thing, only to leave with triple what I planned, like I really needed another perfume. A tip here is to regularly review of reporting and can enable you to make actions sooner. Prepare a budget, plan revenue and expenses, can manage and keep you accountable. Review expenses annually, if not more frequently. One personal example I think will relate to a lot of people is, when was the last time you reviewed how many streaming services subscriptions you were paying for every month? Netflix, Disney, Stan? When you consider it and step back, how much is this costing you per year? I believe it's on average around about $600 per year. On the other side, you can consider, what are you doing to bring money in the door? Did you know personally, if you save $27 per day, you can save up to $10,000 per year? That equates to, after 10 years, $100,000. Little things like this, adjusting or being ahead of it, can make a real impact on your cash flow. Our next common mistake I'll talk about is not monitoring or planning for cash flow. There's some heavy stats here that show 60% of failed SMEs cite cash flow problems as a major cause of their failure. Up to 37% of business owners have identified cash as a significant concern, and 90% of small businesses experience at least 1 month of negative cash flow per year. That's very significant. These figures highlight the importance of regular cash flow monitoring to ensure business stability and growth. Two simple approaches that can help mitigate this or help with planning is one option is knowing your average cash monthly burn rate. Reviewing your general outflow from a period of, say, what we've got the example here is July to October, working out what your general outflows are, as I mentioned before, not just looking at your P&L, looking at your outflows in terms of what's on your balance sheet, those tax and loans and rent, and understanding what the average requirement is to continue to keep your doors open. So for this example here, once you look at the 4 months and divide that by 4, we come to roughly about $17,000 worth of cash we require month on month to keep the doors open. This can provide a great guide in terms of what your minimum cash flow reserve or policy should be, or what you should be bringing in the door. As I mentioned earlier, a client of mine, Rachel, the doctor, Rachel got in touch with me to help manage her cash flow. What I did to start monitoring their cash burn rate was very similar to this approach, factoring in other factors as well. And then what we did from there was set that minimum cash flow policy. So we come up with a minimum cash flow, say about $1 million to service the business. And then over time, as they only receive cash inflows every annum, it was quite stringent that we kept reviewing that every month. So we worked out the average burn rate. We knew when the subscriptions were coming back into the business, the flow of money back in, and monitoring closer to those months coming up to the end of the year to make sure that we had sufficient cash to manage out the year. Should this have varied from time to time, we considered contingencies for managing future costs or calling in the membership revenue sooner, but we're always ahead of time. It's that planning. The other option that we have here is working capital. Working capital is what we need on a day-to-day basis. It's what we need to pay the bills. Essentially, how to calculate this is your current assets minus your current liabilities. So we've got a little example table there. This therefore equates to your working capital available. Positive working capital represents the financial health and the ability to fund short-term obligations. On the converse side is negative working capital can represent potential short-term stress, and how are you going to have problems? Will you likely have problems paying your bills? Being aware of these common mistakes and considering applying these tips can significantly improve cash flow management and can contribute to overall financial health and stability of the business. This then leads me into the next topic, periodic reporting and budgeting. Just going to run through a few benefits to periodic reporting and then budgeting, which is fairly similar. So periodic reporting enhances visibility. It provides regular updates of your cash flow status. It helps you stay informed about your financial position. It allows you to do trend analysis, reviewing patterns in your cash flow, making it easier to predict future cash needs. And a prime example could be if you were paying employees wages weekly. When comparing month-on-month costs, understanding that some months will have a 4-month pay run and others will have a 5-month pay run. So we really need to focus on knowing when those trends are happening to be ahead of the curve. Proactive decision-making, early detection of regular reporting allows you to be ahead of your cash flow issues early, allowing you to take corrective action before problems can escalate. Making informed decisions with up-to-date information, you can make more informed decisions about spending, investing, financing, growth. Ability and control. Monitoring regular reporting ensures that cash flow is continuously monitored, promoting accountability within your business. By implementing controls around measures for expenses, say, adjusting payment terms or cutting unnecessary costs, we spoke to it before about those subscriptions we all have, and stakeholder confidence. Periodic reporting enhances the transparency for your stakeholders, including investors, lenders, owners, by providing clear insights into the business financial health. So on the other side, as I mentioned, benefits of budgeting via actual analysis is relatively similar to periodic, but it's really looking at that sort of more strategic methodology to what you're reviewing when you're looking at that analysis. So performance evaluation, when comparing budgeted figures with actual results, helps track progress towards financial goals. It identifies those variances between what's actually happening and what we expected to happen, highlighting areas that may need attention or to help drive more growth. Informed decision-making, we mentioned before, really helps to understand looking at regular data-driven insights to enable to make better decisions. It allows for timely adjustments to develop strategies based on actual performance. Accountability and transparency. Budgeting via actual analysis promotes accountability by holding certain departments or people that were involved in the budgeting process for their financial performance. It enhances the transparency within the organisation, fostering a culture of openness and trust. And strategic planning is the most important aspect of budgeting. It regularly analysis helps in long-term strategic planning by providing insights into financial trends and performance. It aids in identifying potential risks and developing strategies to mitigate them. Having a budget and regularly reviewing the budget versus actual or periodic reporting is essential for effective financial cash flow management. It helps in planning, control costs, evaluate performance, and making decisions. Next, I'll run you through just a bit of a practical or visual representation of what periodic reporting looks like, is what I'm referring to. You're generally looking at historical data. So as you can see here, we've got a profit and loss comparing historical prior month data from September, August, and July. When we look at periodic reporting going backwards, the insights tend to be helpful but not very detailed. So as you can see here, a quick analysis shows you that it's been a great month in September, revenues increasing compared to prior months. September looks to have mainly potentially have been one of the highest profitable months. However, there's some unforeseen legal costs and advertising expenses, which we have no insight to reference to why. Overall, we made a loss. We need to improve. That's sort of the insights that we may obtain from periodic reporting. Budgeting versus actual analysis. So here you can see what we've got here is a profit and loss showing from July to September 2024, the actual performance. The next column over shows you the overall budget. This allows you to get a clear variance analysis between the dollar figure or even the percentage figure, but line by line for the business transparency to understand what's going on. And the green and red arrows definitely pinpoint where you need to focus on a lot sooner. So as you can see here, the detailed analysis does help us to understand that the revenue is projecting to be a loss of $10,000 compared to what we had as budget, giving you a percentage of a downturn of revenue of 17%. These discussions can create discussions with the sales team, directly asking them who assist with the budget, what were the challenges they had to meeting the budget this month, or will this just be a timing issue? Are we likely to make it up in future months? Expenses materially show some over budget items that might need to be looked into. Advertising, bank feeds, general expenses is a concern on there. Let's look into these and consider future cost savings. This could be a discussion that you're having with your general manager to consider cost control actions or putting in policies for costing. Overall, we can see that they're making a significant loss still. However, we have more informed discussions that we can make and have discussions around meeting our target in future. Next topic we'll move into is forecasting. Today I want to run through just a high level of what is forecasting and different types of forecasting. So traditional forecasting is I'd like to see where my business will be in a year's time. Forecasting involves predicting future financial performance and business health based on historical data, current trends, unexpected future conditions. It helps businesses like you plan for upcoming expenses, revenue, and cash flow needs. Reforecasting. I see this as maybe my original budget may have not been realistic, but let's review it. Reforecasting is the process of updating financial forecasts to reflect actual performance and any changes in assumptions or conditions. It ensures that forecasts remain accurate and relevant, allowing the business to adjust for any plans as needed. For example, a reforecast can be done on a quarterly or 6-monthly basis. Should the business trends not be consistent with what we've seen in our original budget, it allows you to keep ahead of the changes in the industry or economic changes. Then we have our scenario forecasting. This is kind of like a what-if scenario. Scenario forecasting involves creating multiple forecasts based on different assumptions or scenarios. So generally you can have three. Up to three is pretty easy in terms of having a modest approach, an optimistic approach, and a pessimistic approach. These approaches help business owners prepare for various potential outcomes and develop strategies to manage risk or opportunities. I have a client that I work with who runs a consulting business, quite a high scalable business in terms of dealing with banks and doing quite substantial, large projects. What we've done to help him understand the potential options of winning work or not winning work is create multiple forecast scenarios for him. So, for example, we've got one forecast where we're forecasting ahead on all of his contracts that have been committed, which is more of your modest approach, more achievable. Another scenario that we do, which considers his contracts in pipeline, this is looking for an optimistic perspective or a modest optimistic approach. This has allowed him and myself to present monthly realistic financial positions to the board and alternative positions should they hit the lights out and reach those top targets. This allows for data-driven discussions around what could be needed to resource that additional revenue stream or income, considering resources of actually looking at the bottom line to see, can we afford that highly skilled consultant to support with some of these projects at $150,000, and what impact will that have on my profit and loss balance sheet or cash flow? That leads me into three-way forecasts. So a three-way forecast provides a clear demonstration on how impacts to your profit and loss, your balance sheet, and your cash flow relate to the bigger picture. A three-way forecast is a financial projection that integrates three of your key financial statements. That being, one is the income statement, your profit and loss, your balance sheet, and thirdly, your cash flow statement. This comprehensive approach provides a holistic view of business financial health by showing how changes in revenue and expenses and cash flow impact the overall stability. Next is an example to show you what a profit and loss only forecast would look like. So from the left column to the right-hand side, very similar to your budget, is we have your actual year to date as at September. We have the remaining budget for 2025. This allows us to calculate the fin year 2025 end projection. So that's essentially your actual plus your remaining budget equals your projection. Then we put in another column to analyze, well, what was my original budget? What was I planning for? And how is that tracking? This then shows you the variance from a percent and a dollar value to really look into those key items that might not be tracking so well, that might need discussions to look into. So as you can see, it's down the right-hand side again, those insights tend to get a little bit more descriptive, a little bit more granular around the conversations that could be had internally. To recap, forecasting predicts future financial performance. Your reforecasting update forecasts based on actual performance and changes. Your scenario forecasting creates multiple forecasts for different potential outcomes, and your three-way forecast really allows you a full visual of the profit You are predicting your balance sheet impacts to assets and liabilities driven by the business performance, and cash flow forecasts represent the available cash in future periods. So in summary, hopefully you've got a few key takeaways from this presentation, but just remember some of the key items are knowing where you're getting your cash and where is it going. Remember, the most key is profit does not equal cash. Plan, have goals, strategies, involve your team and keep them accountable. Ensure financial hygiene and review and analyze regularly. Be financially ready for investors, lenders, or any potential growth that you want to do in the future. So that's a full cover off of the presentation today. I might pass it over to you, Andrew, or any questions that anyone might have on the topics we discussed today.
Yeah, terrific. And thank you, Aleesha. Some great strategies and tips in there. We can't emphasize how important cash flow is, can we? It's super important. We've got some questions that have come through. A question that's come through, Aleesha, is what program is used for the reports that you presented?
So I've used a combination of two platforms in my reporting. The initial one was Spotlight. We use this for our clients. We actually extract the data from Xero to make sure that we're providing more customized KPIs and reporting for our clients. So it's more of a board reporting style. It gives you a lot more insights. Some of just the simple profit and loss reports I was providing there, just simply out of Xero, creating some customization that works for each individual business or how different key stakeholders like to see reporting. It's quite flexible, so it's very, very helpful.
Okay, fantastic. And just another question that's popped up here. For reporting packages like Spotlight, for example, you just mentioned, how much is that extra to a regular Xero subscription?
Look, a lot of the apps in the Xero ecosystem are fairly feasible. They're there to essentially make your own little ecosystem and tack on things that might be useful for your business. So you don't really have to go to that ERP as quickly as you may need to. You're looking sometimes between $50 and $100 every month, but you really need to look into the time savings and the accuracy and the output that you're receiving. I think once you do that costing analysis, it's actually saving a lot to the business, getting those insights in real time.
Yeah, and that's a really good point, because if we went back 10 to 15 years ago before such good cloud accounting packages, you'd have to pay your accountant each month to do that, and that could cost in the thousands of dollars. So $50 seems like pretty good value to me.
Very much so.
Yeah, and the reports are terrific. Another question that's come through on those, how would you go about getting training on any of these packages, such as Spotlight, so you can get the full functionality?
Yeah, look, again, a lot of the ecosystem apps in the SME space have a range of different resources, be it videos, certifications. Generally, they're pretty user-friendly. We've partnered with Spotlight because it is a user-friendly product. It's stable. So it's pretty easy to get your head around it, but obviously always reach out to your accountant if you need help as well.
Yeah, so plenty of resources out there on the internet, on the provider's website, the developers of the apps. But one thing it really highlights for me when we're watching that is how important it is to do monthly accounts. Is this more of a trend? Are we seeing more businesses doing accurate monthly accounts, and should they be doing monthly accounts?
Oh, I hope so. It's why I do what I do, and I love what I do. I got into this about 10 years ago, sitting there doing compliance, as you mentioned before, without the cloud accounting, and scratching my head to why is it a year later that the client is seeing insights that would have helped them perform better that year. So I really hope so. I think the ecosystem and the apps are helping small business owners be able to achieve that more so than before. But I think we can always do better.
Yeah, I couldn't agree more. And I think that really talks to that idea that business is quicker now. And generally, if we wait to the end of the year, it's just too late to get any good information. So at RSM, we really encourage that businesses should work daily to build their profit, and you build the week, and then the week turns into a good month. And if you look at it soon enough, and that goes to that budgeting, doesn't it? That allows you monthly to analyse month by month.
Yeah.
How important is it for business success, you think, to do a good budget?
I think it's critical, and I think it's critical to keep trying. I know a lot of businesses might tackle it the first year and look at it and say, oh, this is just all variances. It doesn't make sense. What was it actually worth? But you'd be surprised year on year how much you can refine and change the conversations. Just some of the smaller conversations that I've had with clients every year, they're looking into things that they haven't looked into for, say, 10 years, and their cost savings, particularly from an expense side, and even the revenue side, they're driving more sales, actually taking a time to look and consider. But they're really drilling into those expenses more now, seeing those variances from an expense side. I think most small business owners or internal people are looking at going, why? We had a plan. Why are we spending over? So you do see action. I've seen people save hundreds in just one account line, really nutting down on what's going through that account? What are we spending there? So.
Yeah, and do we need to spend it? Is it in our plan? And are we getting value from it? So we've got a question on budgets that's come through, and it's if when looking at actuals and it's identified that the budget is not very accurate, should you keep the original budget and do a new one, or adjust the original budget?
Look, the answer to that can be, it depends. The budget's there. It's not the right answer everyone's after. A budget's there to really use as a guide initially. It can be a guide to create that discussion. The point is, it doesn't have to be exactly accurate, as long as it can give you the insights to make the decisions to change. On the other side, we do need to consider when there is a point where the budget, or as I mentioned before, things in the industry or the economy is changing, where we do really need to reassess, are my sales completely overstated now? Is that going to wind down a little bit? Equally, we need to then drill into our costs to make sure that we're going to be on that positive cash flow that we mentioned before.
Yeah, excellent. So if we move now from budgets to cash flows, we've got a question on cash flow, and it's for a growing company. What is the recommendation in relation to a cash flow review? So I believe that's, how often should we review it, and what sort of cash flows should you set for a startup or a growing company?
Look, it depends. Now that I think about it, it depends on the industry. Some industries we might need to be a bit more frequently looking at our cash flow. We wouldn't necessarily, might have to be daily, but I think that would be a nightmare. But what we'd be looking at as a new sort of progressing business is at least looking at things maybe weekly. Really, you're not across the full trends of the business and the cash inflows and outflows as yet. So the sooner and the more often you're looking at those, you will be able to sort of extend the review period in the longer term. So what I would tend to do for many small businesses starting up is every time there is a material outflow, say payroll, BASs or supplier payments, which I like to align where possible so that you don't have to manage your cash flow as many times throughout a month or a period. Have a look at what your opening balance is, what are your expected outflows, and where you're going to land at the bottom. And it really helps you sort of plan. And then that comes forefront of mind as well. As I mentioned, you'll start to understand your trends a lot sooner and be able to plan a lot better for the longer term.
Okay, so this is a question from me. If we had a package like Spotlight, does that automatically do some of that cash flow work for us into the future? So help us set a cash flow budget? And if so, how does it work? What does it do?
Yeah, great question. This is one of my favorite things I love too. I do geek out on it. So what Spotlight does is pulls the actual data out of your accounting software, and it automates the actuals as at that period. So say we were looking at September, we'd pull the actuals after we've closed the accounts into Spotlight, and it will generate your three-way forecast for you based on the budget that you've built. So the budget's input into Spotlight. You put your actuals in, and then it'll reforecast the rest of the year from that profit and loss, balance sheet, and cash flow statement. So it'll reforecast. You do need to have a bit of an accounting mind to understand that there are some timing variances that you need to populate and configure into the balance sheet so that it does reflect the right inflows and outflows, such as when your GST payments are, when your creditors and debtors. It's quite complex from that side a little bit, but if you there's lots of resources available to do it. Otherwise, reach out to your advisor.
Yeah. So, but that doesn't sound like a really big job. So that might be half a day with your accountant to get it set up, and then maybe an hour a month of maintenance to keep it going. So it's not super.
But one time set up every year. Your budget will change, so you and it's a good chance to stop and do your budget and have the discussion with your advisor as well if you can. But it's a one-time setup. Everything should flow thereafter. And then allow you time to actually sit and digest the reports a lot more timely. Yeah.
What I love about having a budget and monthly accounts is that you can actually look for issues before they become problems. Is that have you seen examples of that?
Yes, daily. I was just pulling a report together this afternoon, looking at something that we need to consider might be impacting a client soon. And that's a discussion we'll be able to have now rather than in 3 months' time when it's too late.
Yeah, that's excellent. So other questions that have come through, and I suppose is just one last question to wrap it up, and I think it's a great one to summarise it all. Is somebody's asked, is cash flow becoming a bigger issue for business currently, and how are clients handling this?
Oh, look, I think we're all feeling the pinch at the moment. I see a lot of clients at the moment they are planning. A lot more people are planning, and they're drilling into their costs, I think, is a big component. Conscious that the revenue might be slowing down in certain industries, they're drilling into what costs are really not sufficient this year, and where can I, cut the mustard? I don't know if that's the right saying.
It's a good one, though. So really assessing what's essential. What I really liked, as you said before, you save $27 a day, and that will save you $10,000 a year. Quite often we think that profit improvement is big steps, but sometimes it's just little steps. And if you pick up 2 or 3 areas of that across your business and your accounts, all of a sudden you're saving $30,000 a year, which adds up.
It's very quick. I think you'd be surprised. So hopefully a lot of you listening in are going away and at least just drilling into your costs to see where there's some savings.
Yeah, well, thank you very much for that, Aleesha. I certainly know for one, I'll be going home tonight and checking various unused subscriptions, see if I can save a bit there, because that also adds up personally. So thank you, everyone, for attending our webinar today. Terrific. And thank you once again, Aleesha. Some great tips and strategies there. We will have a recording of this webinar at the RSM website. And once again, thank you very much. And that will be us for today.
Thanks, everyone. Thanks, Andrew.